Hey y'all, Katie here, and welcome to Make Dollars Make Sense, the podcast that helps you teach your child financial literacy. Catch us here once per month on your favorite podcast platform. Just do a quick search for MOMnation Talk Radio. Enjoy the show.
All right, guys, welcome to Make Dollars Make Sense. Because it is the month of credit, we decided to have Sue Buswell here. She is just a credit guru, knows everything to know about credit. And she's going to go ahead and talk with us about how you can kind of get a hold of your credit and take hold of what most people think controls their everyday life. So take it away, Sue.
Thank you so much. I appreciate you inviting me to be on today, and I'm happy to be talking to your audience about credit. I've been in the credit industry, specifically in the mortgage space, since 1985. So the gray hair is real. It's not bad lighting. But what I think what I really try to advocate for is the fact that credit is a necessary evil, right? We have to have credit, but we don't want to live on credit. And so I quite often, you'll hear me say, if you follow me on LinkedIn or if you check out some of the information on my website, I will say that debt to live is not a lifestyle. And I think if you think about some of the most prolific investors, they've always said, use other people's money. Same thing with credit, right? Use other people's money when it makes sense. And when you're young and starting out and building your credit, you do have to be in debt, so to speak, to get a score. So, there's some differences. So you might notice over my shoulder, I've got two little things up there. One is Sue Knows the Score, which is my hashtag for LinkedIn. And then I've got Vantage Score, how Vantage Score ranks our information. But today it's pretty much all about FICO, although Vantage is coming in. It's coming in very strong, and it's allowing people who don't count under the FICO models to count. So I think those are a couple of the threads that we could pull on today. I don't know if there's anything specific that you'd like me to dive into and tell your audience about.
Yeah, just pretty much just an introduction into credit and why it is that necessary evil. Because I know just a bit about me is where when I grew up, it was all my parents kind of taught me just pay with cash, pay with cash, pay with cash.
Mm-hmm.
And then when I turned 18, I'm like, ooh, I could get a credit card. And I got that credit card not knowing anything about credit. I just got that credit card, ran it up, and didn't have any money to pay that back. But, and then it took a while to get my credit score back up, and because I didn't know how. And then I started out, like you said, with, utilizing other people's money. So I think if you could explain why it's a necessary evil, I think that would help a lot, because I think people are just scared of credit.
Yeah, absolutely. So credit is one of those things, and I'll go back in my history. So in 1985, I started working at a TransUnion credit bureau. So I really learned about credit before I had an opportunity to get myself into trouble with it. Now, that doesn't mean that I didn't have to learn some lessons along the way, just like everyone else, right? So our current FICO models, which are really predominantly the score model that's used for autos and cards, credit cards, housing specifically, right? Those models all have a very generic process of looking at your credit. And I want to share with you kind of what those big things are. As I said, there's the Vantage score over there, but I flip that sign around and you'll see the FICO. And I won't flip it, but we'll just talk through them. So 35% of your FICO score is your payment history. So I often think about, what have you done for me lately? Great Janet Jackson song from way back. Those of you that don't know it will have to go look it up. But that's what FICO's doing, right? Everyone wants to get credit really complicated, and it's not. It's really can be very, very simple. 35% of your score is what have you done and how have you done it? 30% of your score is what is your balance to limit on revolving accounts? 15% is how long have you had credit? Now, if you're just starting out, you can't fix that category. It is what it is. It's 15% of your score. 10% is your appetite for new credit or inquiries. And the final 10% is the types of credit that you have. And it's a little bit deeper than just revolving versus installment. So we'll kind of backtrack and go through each of those pieces. I'm going to go back up to the 35% category. And as we talk about it, the thing that most people don't understand about credit scores, all of our credit scores on the market today are built to determine what is the chance? What is the risk that you'll become delinquent on any debt? On any debt, 90 days or greater within the next 2 years. That's what these models are scheduled to predict. Okay. So let's stop and think about that for a minute. Credit scores are risk predictors. And I want you guys to think about, your college friend, your high school friend who was borrowing money and never paid it back, right? After a couple times of that, do you keep borrowing, lending them money and letting them borrow money?
Absolutely
Nope.
not.
Right? Because, and this is an old, I'm going to say Dr. Phil saying, but I think he just made it popular. The best predictor of future behavior is past behavior. That's what your scores are doing. So it doesn't have to be complicated. It really is, what are you doing? How are you doing it? And how much are you doing it? When you stop and remember that scores are really risk predictors, and they're going to take a look at what have you done to determine what you're going to do. So what if you're doing everything right? You're paying all your bills on time. You're keeping your balances low on your accounts. You've had credit for as long as you could. If you're in your 20s, you can't have had it for longer than a few years, unless there's an unless. I'll come back to that. And you've got the right kind of credit. We'll talk about that too. And you're not applying for a lot of credit. So I'm going to stop at that one, at the inquiry piece, because a lot of people get confused about inquiries. And one of the things that makes me crazy about credit is Christmas. Why does Christmas make me crazy? Because I'm standing in line and people are being told by the cashier that if they apply for a credit card, it's only going to take 5 points off their card, right? Off their score. Mm-hmm. So get this credit card, you'll get your 15% off, and it's only going to take 5 points off your score. She can't tell you that. They're not credit experts. No one can tell you with any level of accuracy the exact score points that will be impacted by a single inquiry, because credit is very personal. And kind of like you mentioned at the beginning, right? We get a credit card, we don't know what to do with it. I did the same thing. I got a $500 department store card for my job at the credit bureau, and I needed a little bit better than jeans and a t-shirt to go to work, right? So I ran that thing up to like $300. Well, back in the 80s, that was a lot of money, right? I didn't have the ability to pay that 300 back. So I became part of that debt to live society. And then I realized that that's only to the benefit of the creditor. Mm-hmm. I'm paying them interest on money that I use to wear this shirt. That's kind of silly, right? Like, why would I want to do that? Mm-hmm. So, fast forward 30 years, and I realized that what I need to do is use that credit that I've been given in a very responsible way. And that means that every month that my statement comes in, I pay the statement balance. Matter of fact, I don't even look at my statements. I just have it pre-programmed. Whatever the statement balance is, I pay that in full. And I use my credit very, very carefully. So I think there's a lot of tips and things that people can take away. Mm-hmm. Another thing that, we talked about the 35%. What have you done? How have you done it? 30% of your score is your balance to limit, specifically on revolving accounts. But there's been a myth created about that where people think that their balance to limit should be 30%. No, that's the percentage of the score of your balance to limit. For most people, your balance to limit should probably be between 10 to 20% to optimize your credit score. So I want to make sure I talked about that. Yeah, that 30% is that's a big myth. And
that is a huge misconception. I'm guilty of telling people that's good to know.
Yeah. I mean, and again, it's personal. So someone who's had credit for 10, 15, 20 years could go higher on their balance to limit. Mm-hmm. But if you really want to talk about something that's a goal for common people, everyone to follow, 10 to 20% is best. And that's going to include home equity lines of credit. Mm-hmm. Those are revolving as well. And that's where some folks get in trouble when they're maybe trying to sell a home or refinance a home. They've got a huge balance on a home equity line of credit. And it's not like, paying a couple $1,000s down in a credit card. That's a significant amount of money.
Yeah.
Yeah. So that's one of those things.
Take, 50 to 100,000 out. Equity.
Right. Like, where am I going to get that money from? That's why I took it out of my HELOC for, right? But they don't realize it's a revolving debt. and it will impact their score in a negative way if they take out a tremendous amount of money on that. It's just like any other revolving account.
Yeah.
So I think those are some of the secrets, right? So as it comes to your 35%, a lot of that's going to be focused on the most recent 2 years. The score looks at everything. Don't read that to say only the last 2 years count. It puts more weight on what's happened in the last 2 years. The same thing with your balance to limit, right? We want to try and keep that low, 10 to 20%. And then I mentioned on that 15%, that length of credit history. If you're in your teens or early 20s, and you didn't get your first card until you were 18, 19, 20, what have you, you don't have a length of credit history. But we all know that authorized user accounts can help someone get a longer history. It's a no-no quite often when it comes to mortgage transactions.
Yeah.
But, personal story, my little brother needed to rent an apartment a few years ago and he didn't have a score. He was a cash buyer, right? He just didn't have a score, did everything in cash. And so I put him on a credit card, and within 45 days, the creditor reported the information and he was able to get into his apartment. So there are some instances for people who are trying to either step into credit or step up into credit. He was able to take that authorized account, get his own credit score, and then go out and apply for credit in his own name. And so we need to think about how we build our credit can be very important. So for anyone who's got kids out there, there are a majority of MasterCard and Visa that will allow you to add your children at 13 and younger as authorized users.
Oh, that's good to know. Like,
yes,
I have a 16-year-old and I was just talking to her about, she got her first job, and I really just, it's really important for me to, break my generational habits. And I really want to put financial literacy like hovering in her mind.
100%.
So that's great to know. That's good.
That is a really good tool, but you have to make sure when you add someone as an authorized user to your account, you don't have to give them a credit card. I love my brother. He doesn't have my card.
I want to give my daughter.
It's like he doesn't have it. But you could add her as an authorized user today, right? At 18, when she's ready to get her own credit, she's got all your credit history for that card. If you've had that card for 7 years, 2 years from now, she'll have 9 years of credit history. Right. Yeah. And that's going to look a little strange in some circumstances, but in a lot of places, they'll be like, okay, now let's get a secured card. So even if you don't make her an authorized user, those credit builder secured cards are great options for people to get started on their credit.
Yes, that was what saved me is when I was, how long was it ago? I think when I first started, really started working on my credit, it was probably about almost 8 years ago. And I was like high 400s. It was bad. So my credit got to the point where it was so bad that I just started dealing in cash and I didn't want to touch my credit, which was difficult to be able to live life. It's something you really can't avoid. And so, that's one of the first things that I did. Well, the first two things that you touched on is I got added as an authorized user on one of my fiance's long cards. And then I also took out a secured card, and it was only $500, but that was the two biggest things that helped me.
Absolutely. Now, here's a trick with secured cards is don't ever run a balance where you're paying the creditor interest on your own money, right? And a lot of people don't think about that. They're like, well, I put $500 down on my card and I have a $750 limit. And next thing you know, they owe $700 and they're paying interest on it, right? And they don't realize that they're actually paying interest on their own money, but to someone else. That's not the way we want to do it. We want to make sure that we're paying ourselves interest. So one of the things that I typically try to recommend to folks, and it's a little outside of the credit space, but it will circle around. You'll see what I'm talking about. I prefer to bank, if you will, with a credit union. So as we talk about, being money smart and being credit smart, a credit union is built to help their members. They actually pay you dividends, which is interest and, profits, if you will, because they're a nonprofit agency on your own money. You can get a savings secured card. You can get a credit builder card. They have a lot of financial education that they offer there. It's just different than the way that the banks traditionally do it. So if someone's starting out and they come to me through one of my credit coaching opportunities, I usually will tell them, and talk to them about where are you banked. If you're unbanked, that's one thing. But if you're with a bank and you're not getting credit for your, business there, then maybe let's talk about another option. I had a great story of a gentleman shared that his daughter was turned down at the bank that he was, you know, pretty high up in the management with because she didn't have any credit. And they ended up getting a credit builder card from a credit union, and they moved all of their accounts over to a credit union. So there's a lot of opportunities for folks to get started in credit. And like your daughter coming in the next couple of years, those are great conversations to have. There's also some great apps that are out there. And I'm sorry, I didn't jot those down, but I can always send them afterwards so you can share.
Yeah.
But there are some great apps for kids to start understanding about credit building. I think for adults, there's some conversation out there about Chime and some of those other types of cards. And the way that those work is you deposit your paycheck, and then that's your credit limit. So let's back up to that 30% balance to limit, right? If I deposit my paycheck of $1,500 and I need to pay my rent, which is $1,000. So it's going to show that I have a $1,500 credit limit and I have $1,000 balance, right? So we have to stop and think about how those cards work and if they're going to impact our score in a negative way.
Got it. Okay.
Does that make sense?
It does. Yeah. I didn't know that this worked like that. I thought that they were just like normal secure cards. I didn't know you had to do your.
No, it's actually an income deposit account. So if I deposit $1,500 and I spend $1,500, my balance to limit is always going to be too high, right?
Got it.
Always going to be too high. So that's just one of the things. And that's been a complaint from some folks as I did some research for my posting about that on my LinkedIn account. So I do post every week. Generally, I follow a topic all week long. I did a great one on buy now, pay later. So that's another thing we have to be careful of in the mortgage industry specifically, because most of it's not reported. So we can't see that. But let's circle back to the scores for a minute. We talked about inquiries. We talked about the balance to limit, revolving accounts. We talked about payment history, and we talked about the length of time accounts have been established. So that leaves us with one category, which is the types of account. So when I ask you, what kind of credit do you have? What do you think of?
Credit cards, or maybe your mortgage, student loans are some of them. Pretty much those are the ones that come to my head first.
So what I want you to think about when you think about the type of credit is how the credit scores look at that. And yes, it's looking at revolving versus installment. It's looking at mortgage versus student loans, but it's also looking at the type of creditor. And most people don't realize that our creditors are scored as well. So tier 1 type of creditors are your banks and your credit unions, your major MasterCard and Visas, right? So that's like, we want tier 1 credit, right? Tier 2 credits, your department store cards, right? So your Target card, unless it's a MasterCard Visa, back in the day when JCPenney card, those types of things, right? Finance companies are also tier 2. And then tier 3 are more of those creditors that are not typically reported, like your rent or your telecom, utilities, those types of things. So what does that mean? If I had a borrower who had the exact same credit look, their payment history was perfect, their balance to limit was perfect, their length of time they've had credit, right? So you and I are on this shelf and we're exactly the same, okay, credit wise. But I have all tier 2 and you have all tier 1. Who's got the higher score?
Tier 1.
Tier 1, yes. So we don't think about who we do business with, who we choose to have our credit relationships with can impact our scores as well.
Yeah.
And the mix of accounts is necessary. So I'm not saying dump your department store cards and close out that finance account. What I'm saying is be thoughtful about who you do business with. So auto loans, for instance, when I used to buy and sell cars, as we kind of do as we're coming up, right? We start with what we can afford and then we change. I might buy and use the financing at the dealer, which is usually something finance company.
Mm-hmm.
What's a finance company? It's tier 2 credit. It's not bad. If they're giving me 0% interest, I'm in, right? But once I started working with credit unions, I would always go to my credit union, get a pre-approval letter. I would go to the car dealer and I would say, I picked out this car. This is the price I'm willing to pay. Here's my pre-approval. And my interest rate was almost always the same or better than what the car dealer would offer. And then it was a credit union loan, which is tier 1 and not a finance company account. So I started to do that because I understood the difference between tier 1 and tier 2. And that's something that's really not talked about in relation to scores.
Sorry, I had to mute myself. My family's going crazy out there.
That's okay. I have one dog in here and one outside. I'm hoping that they will both stay quiet until we're done.
Well, and that's really great to know about the tiers, because I had no idea. I didn't know that there were tiers like that. I'm just like, oh, credit is credit. I would just look at the amounts, but I mean, that totally makes sense now that you say it.
Yeah. Yeah. So it's like I said, who you do business with can really affect your score as well. And I think that's something that we overlook quite often, just like we often think, right back to that myth, that 30%. I have to keep my balances below 30%. No, 30% is how much it counts in your FICO score. Now, when Vantage Score goes mainstream, those will all go away. There's a whole different category. So maybe I'll come back and talk about Vantage Score with you guys someday.
Yeah, and then to go back, I wanted to kind of touch on something that you said about closed accounts.
Sure.
I know, and then longevity. I know that there's some people who they're really trying to fix their credit and they're not seeking any help from a professional, and they go and pay off their cards, then they close it out, and then they have this relief feeling. Can you explain why that is like a huge no-no?
Yeah, absolutely. So paying down your accounts to a manageable level is perfect. I have a credit card that I've had for over 20 years, and I have a streaming service on it. It's $5.45 a month for the streaming service. That's all that I do with that card. And I have kept that 20-year-old card active because of that. So closing an account, let's remember this. FICO puts emphasis on the last 2 years. It looks at everything, but it puts emphasis on the last 2 years. Yeah. So if I close out an account and I stop using it at 6 months, it's already started to negatively impact my score because I've lost my history. At a year, I've lost more history. 15% of our score is the length of time accounts have been established. And once they close, yes, it's still showing how long you had it. But there's 2 things on your credit report that determine the weight of the individual trade lines. One is the date reported, and the other one is the date of last activity. So if I'm looking at my Chase account and every single month it's reporting, and every single month I have activity because I have that $5.45 thing on there, then it's going to make sure that all that history is current and it's active. If that same Chase account, because when I close it and I don't use it, Chase can continue to report it, but the last activity date goes 6 months old, then it goes a year old, then it goes 2 years old. It's not counting. It's not helping me anymore. So absolutely keep your balances low, but if it's a revolving debt, put something little on it or use it every 3 months. Even if it's a tank of gas, use that card every 3 months and then pay it in full. All of my credit today is all set up on auto pay, and it's my cell phone bill, my power bill, all of that is on my credit cards because I don't use credit in the same way as I did when I was building, right? So it's no debt to live. And hopefully we'll get out of a society where we need to have debt to live. But for now, that's the smart thing to do. Get credit, but use it very, very cautiously. And if you do get it, keep it active by utilizing it just a little bit every month and paying it off.
Yeah, I mean, that was the third thing that's been helping me a lot is I actually never use my debit card. I only use my credit card. I have well, I have more credit cards, but I have one main credit card
Yeah.
that I use for all of my expenses, but it is on auto pay to 100% pay off. So I'm using other people's money, but not paying
Very
any.
smart. And if you're using a rewards card like I am, then
Yes.
you're earning those flights so I can bring my
Mine's
niece
a
and my
Southwest
nephew
one.
in.
Yeah.
There you go.
And we recently use, I try to put as much as I can on it. And anytime we go on a family vacation and they're like,
Yep.
oh, we have to book an Airbnb. I'm like, I'll put it on mine because I get all those points and
That's right.
and then we can get like a companion pass or free flights.
Mhm.
So that's always great. But well, awesome. Well, I'll make sure if you can email me those links, I'll put it for our viewers.
Yes, absolutely. I need to get those for you. So that the children, there's a link that I'll send you that indicates which credit cards and at what age. You can do an authorized user. I'll send that. And then also some of the credit builder cards and apps that I saw. So yes, I will share those for sure.
Perfect. Yeah, that would be amazing. But thank you so much, Sue, for coming on. I appreciate it. And then for all of our viewers, no matter where, where you're listening, whether it's on your, favorite audio book source like Audible or anything like that, or on YouTube, just go ahead and search MOMnation USA. And that's our handle for everything. And you guys could go ahead and find that. And then if you need to contact myself, you could go to the link that's going to be in this video. There's a link to my profile, and then we'll also have Sue's there as well, so that you guys could connect with her if you have any questions. But thank you guys so much, and I appreciate you very much, Sue.
Happy to be here. Thanks, Sonya.
Thank you.